Hi everyone, my name's Kashish and welcome back to the last experiment episode of Just a Little Beyond the Headlines. Here we don't just repeat the day's biggest stories. You could get them anywhere. Instead, we take the major headlines floating around the internet, serve them with that one extra insight you won't catch just from reading the headline. That's what makes the show Just a Little Beyond the Headline. We keep it very simple here with the EIC format. E for economy, I for industry, and C for company. So whether it's a big picture macro trend or the latest corporate shakeups, you can get all of them at one place. So let's dive in. Let's start with the economy. First, India has set a very bold target. 70% of female workforce participation by 2047, according to the Labour Secretary at the G20 Employment Working Group. Sounds great on paper, right? But the gap here is very massive. Current participation rates are stuck at around 24%. So how will we get there? The government is banking on measures like extended maternity leave, improved creche facilities, and equal pay provisions. They're also promoting jobs in high growth sectors like IT, R&D, and engineering while leveraging schemes like employment linked incentives, that's ELI, to push for formal employment. There's also a push for skill development to make women more employable and expanding social security coverage to reduce job-related vulnerabilities. Now, this is a very solid plan on paper. But unless deep-rooted cultural and workplace barriers are addressed, this could end up just another number for a future PowerPoint slide. Next on, we have India and China's trade problem. A McKinsey report highlights India's growing dependence on Chinese imports, which has risen by 6% annually since 2017, especially for electronics, chemicals, and machinery. Meanwhile, exports to China have shrunk by 2% per year. And here's the big deal. Asian countries like Vietnam and Malaysia are also importing more from China, but using those materials to produce higher value goods, which then they export to US or Europe. So their exports have also increased, turning China's reliance into profits. While for India, that is not happening. Instead of boosting exports to offset rising imports, India's trading gap with China is widening even more. So while Asian countries play a very smart middleman role here, India's current strategy risks leaving it stuck with higher import bills and none of the trade rewards. Finally, for the third story of the economy, Argentina comes to India's rescue for lithium. You see, ET reported that India just signed an MOU with Argentina to explore and mine lithium because securing EV battery power from halfway across the world apparently feels easier than mining or unknown here in India. Back home, we've discovered lithium reserves in Jammu and Kashmir, Rajasthan, and even Karnataka, but progress has been really slow. Why? Now, there are multiple reasons. Bureaucratic delays, incomplete exploration, and even red tape that has stalled auctions and approvals. Meanwhile, this Argentina deal promises joint ventures and long-term supply agreement from the Lithium Triangle. Now, this lithium triangle is a group of 3 Latin American countries with high concentration of lithium. If it works, great. India's EVs plan will stay alive. If not, we'll still be stuck importing lithium from China and they'll continue to corner the battery market for their own good. Next, we have the industry news. First, NSDL and CDSL have teamed up with SEBI to launch a unified investor platform because, managing your investment across 10 apps was getting very old. Now, this new shiny app promises a consolidated view of your financial statements, your shareholdings, and investments, all of them in one place. Now, this might sound very revolutionary. Well, not really. We already have the account aggregator framework powering fintech apps and the consolidated account statement, that's CAS, giving investors a snapshot of their holdings across accounts. The twist here is that this platform pulls real-time data directly from NSDL and CDSL, promising fewer delays and more seamless experience. Now, the SEBI chairperson is calling it democratizing investing. But let's be honest, it looks like old wine in a slightly shinier bottle. Next up, there's news about diamonds. Now, according to an ET report, natural diamond prices in India have dropped by roughly 30% since 2022, falling from 5 lakh per carat to 3.5 lakh. Now, reasons are multiple. First is a surge in lab-grown diamonds in the US, which are so much cheaper than the real ones. And then there's declining demand for China as well. Meanwhile, gold prices, on the other hand, have actually soared by 60% during the very same period. Now, you'll think that cheaper diamonds would hurt jewelers' profits, but that's not really the case. Here's a plausible explanation of why they actually might be benefiting from this. Falling prices boost demand, bringing in more customers. At the same time, jewelers are now sourcing diamonds at a lower cost while maintaining stable retail prices, which might actually potentially improve their margin. Plus, with gold prices sky high, diamond-studded jewelry, which uses very less gold, becomes an attractive alternative. So while the prices are dipping, volume sales and margins might just be saving the day for all these jewelers out there. Now onto the third story. The Power Ministry has told India's power distribution companies, that are Discoms, to get their financial act together. Basically, if these companies want future investments, be it in terms of loans or funding to improve their infrastructure, they need to stop bleeding money and start charging consumers enough to cover their actual costs, what the ministry is calling cost reflective tariffs. Now, some companies like Adani Electricity Mumbai Limited are actually doing really well in terms of efficiency and service, which is why they topped the recent government utility ratings. Others, not so much, especially the government-run discoms, which are still lagging, even under the schemes like the revamped distribution sector scheme, which was meant to improve finances. According to RBI, these state-owned discoms have racked up staggering 6.5 lakh crores in losses as of 2023, severely impacting state finances. Now on to the final section, the companies. First up is about Google Pay. Google Pay has started charging a convenience fee for bill payments made using credit or debit cards, ranging from 0.5% to 1% plus GST. Now, this move is aimed at covering processing costs as card-based transactions grow on the platform. Now, this shift isn't really unique to Google Pay. You see, PhonePe also charges for card payments, while Paytm adds a platform fee of around 1 to 40 rupees depending on the transaction. The good news here is that UPI payments via bank accounts will still remain free as of now. But as fintech platforms look for ways to turn their large user base into sustainable revenue, these small fees could become even more common. So while the payments stay convenient, they might not stay free forever, as we've seen over the past couple of years. Next up is about an acquisition in the green energy space. ONGC-NTPC Green, which is a joint venture between ONGC Green and NTPC Green, has knocked on Competition Commissions of India's, that's CCI's door, because they're seeking approval to buy 100% of Ayana Renewable Power for 19,500 crores. The goal here is simple: consolidate all the renewable energy assets and tighten their grip over India's growing clean energy sector. On paper, this sounds like a smart move. Two fossil fuel giants trying to clean up their act. But there's a twist. You see, ONGC-NTPC Green isn't even operational yet. It was established in November 2024 with zero revenues. The deal is supposedly smooth sailing with no competition concerns. But given India's bureaucratic love for red tape, we can only imagine how long will this actually take before the acquisition happens. Finally, the third news is about Mahindra and their venture into high-tech security. The Mahindra Group has teamed up with US-based Anduril Industries to co-develop AI-powered security systems. What's on the agenda? Some fancy-sounding stuff like autonomous underwater vehicles for surveillance and counter-drone tech to zap out the threats out of the sky. Now, this isn't Mahindra's first foray into AI-driven security. Previously, Tech Mahindra, which is a subsidiary of the Mahindra Group, has partnered with Horizon 3.ai to enhance AI-based cybersecurity solutions, focusing on autonomous threat detection and penetration testing. Sounds very fancy, but I know they're doing something on the AI front already. While other companies are exploring AI in cybersecurity, the Mahindra collaboration stands out by targeting both maritime and aerial security domains, aiming to get stronger in the regional defense capabilities with advanced autonomous solutions. And that's it for today. I hope you enjoyed. I'll see you in the next one if that happens.